All right, another day where the Dow Jones still muddles along just off of recent highs from about a week ago. Let's kind of summarize first the first two quarters of the year, as of course, Friday will mark the end of Q2 23. The market is up about 14% on the S&P 500 this year, up another only about 4.5% on the Dow Jones this year. The Russell 2000 about the same, 3.5% is all. And of course, the stellar 7 incredible stocks that represent over 50% of the NASDAQ 100 is up a whopping 34% on this year. So we see the NASDAQ has clearly led the way for the market to advance this year. It has literally dragged the S&P higher, and to a smaller extent, the Dow Jones. In last week's AI Circle, and probably in an AI Circle even prior to that, we commented on these 7 incredible stocks that have skyrocketed the NASDAQ to be up over 34% on the year, literally dragging the other indices higher. So that is the world we live in today, where the S&P 500 is being dragged up by literally the 7 stocks. So we all know that. But I think we have to put some things in context of what's going on around the world as well. So we kind of know that the backdrop is much higher interest rates, around 5%. We see that literally from everything from ETFs that pay that to bank CDs that pay almost 5% on literally 3-month or 6-month CDs at a bank. And you can get that in the money markets as well nowadays. But I think the major context is what's going on around the rest of the world. Well, the rest of the world has very similar interest rates now. And I think it bears looking at some of the foreign markets to be able to get context of what's going on. So let's start with just our own S&P 500, and let's look at it year to date, like we are here. And we see that here's the S&P's rise of about 14% year to date from literally the 3rd of January, which is the first trading day of the year. Look at the NASDAQ. Same thing, however, it's up 34%. If I were to look at the Dow Jones, we've already see that, but the Dow Jones is up only 4% on the year. But let's look at the Hang Seng Index. This is a representation of the Hong Kong market. Down on the year. Interesting. Let's look at it in context from COVID. There's COVID here. And obviously the Chinese market for Hong Kong is much lower. We know the reasons why, but let's keep this in context. Let's look at the Nikkei. A different story. If we look from COVID, the Nikkei is doing well. However, if you look in 2022, where our markets were down significantly, 20% on the S&P, the market for the Nikkei 225 was actually up in 2022. Let's take a look at the German DAX. The German DAX is the German equivalent of the S&P 500. And if we look, 2022 was a down year for the DAX, but not much. And lo and behold, the DAX has come off of its lows in 2022 or 2023 as well, and it has gone back to its old all-time highs. Because if we even see COVID, it made its highs very similar to America, and it is sitting literally on the highs, whereas the American market's 10% off its highs. Let's look at this. This is the French CAC market. And if we look at this, very similar. The market has just recently made an all-time high. However, it is only barely above its COVID highs. And therefore, what we saw again in 2022, Europe didn't do as bad as America. And Europe, of course, has done better in 2023 than the S&P 500. It's up literally 17%. Let's take another look at something else very important. This here represents, let's see if I can find it. Where's the FTSE? I don't have it close, but the FTSE is the UK market, and the FTSE is trading also just barely off of all-time highs. However, again, it's not much higher than prior to pre-COVID. So around the world, the markets are up and being dragged up by these same technology stocks that trade on their markets as something called an American depository receipt. So what I'm pointing out here, folks, is that in many cases, the worldwide markets are also being influenced by technology in this country. And it's literally dragged the world markets higher. But the same kind of cancer seems to exist all around the world. The higher interest rates, higher inflation has added really deep value to technology, which has literally brought up the worldwide basic stocks kicking and screaming. Let's look at the 30-year bond. Now we know we still have an inverted yield curve. Sorry, this is not the 30-year bond. This is the FTSE I was looking for. As you can see, just off of its all-time highs and not doing very much on the year for the FTSE. It's literally just flat. But I want to show everybody this, the long-term bond market. This is what's happened to the bond market since 2022 and even right after COVID. Interest rates made a high again in price right after COVID and has been going south ever since. The market is stabilized here at about 3.9% or so on the 30-year bond, about 3.75% on the 10-year bond, which is right here. Why are these things significant? Well, they're significant for a reason that interest rates really are a driving force with all price action around the world. Interest rates are literally, long-term interest rates are literally at their lows in prices and very close to their highs in yield. So this here is, for example, a 2-year note. A 2-year note is literally close to its lows, yielding the most it's yielded in, goes back over 10 years. I can tell you it's been 20 years since this note has yielded 5%, and that's kind of where we're at, folks. The yields on short-term interest rates are extremely high relative to the stock market, which means this: over time, these interest rates are actually going to have to go higher, which means lower in price. And we already see this in the Federal Reserve signaling that further rate hikes, not cuts, are in store for the United States and around the world going into the third and fourth quarters. One thing I want everybody to note: the third and fourth quarters generally can be problematic, as we all know about September and October being very problematic months for the stock market, especially given that the recession that we all thought, including myself, that was going to occur did not occur yet, either in the first and now second quarter.